Alrighty. Well, hello everyone. Thank you so much for attending today's webinar on investment basics. We are hitting 11 on the hour, so I want to start promptly as promised. At 11, be respectful of your time as well as mine. So thank you again for attending. Today we are going to be covering investment basics. So I've got a lot of good content for you today. No matter what walk of life you're coming to our webinar with, whether you're just getting started in investing, you're mid-career, you've been investing for a while, you just want to do a quick check-in, see if you're set up right, or of course, you're nearing retirement. One of the things that we're going to talk about is those different phases of investing. A person who's just getting started out or a younger person should have a drastically different, in theory, investment allocation and strategy than a person who's mid-career and a person, of course, who's nearing or in retirement. So we're going to make sure to cover all that and more today. So stay tuned. All right. So a little bit about me. If this is your first webinar or you just haven't gotten to know me a little bit yet, my name is Lucas Amel. I'm a financial planner with Mass Mutual, but we kind of break it into a couple different things. I'm affiliated with this agency. We're called West Point Financial Group. So we are the largest agency in the Midwest, servicing, upwards of 500 plus households, clients in all 50 states. I am as well, within that West Point, a managing partner of the Lettenberger Financial Group. So we're kind of an elite team within Mass Mutual, within West Point, where there's myself and my two other partners, Jason, as well as Daniel. Between the three of us, as well as our, 4 staff members, we're overseeing upwards of $250 million. So when it comes to investing, we know a thing or two about a thing or two, right? So when it comes to my education, I went to Carroll University up here in Waukesha, Wisconsin, studied finance, investments, entrepreneurship, kind of went on to get a myriad of other certifications, passing a lot of industry regulation tests, examinations, which allow me to represent people in pretty much any capacity under the sun when it comes to financial planning, from fee-based planning to investment management to insurance. We're able to kind of help people where they need it. In terms of experience, I've been in the industry now for 8 years, kind of gone through a myriad of different focuses, emphases, and now, I'm more well-rounded, but I come from a background of estate planning, so making trusts, making sure that, there's a smooth transition of assets from one generation to the next. From there, I kind of bounced into doing taxes, tax planning, and financial planning as a whole, which was really, in my opinion, the start of my whole journey. So I've represented thousands of families before the IRS through tax returns, kind of seen a lot of what can go well for people, and unfortunately, what it looks like when, people aren't as proactive with their planning. So that ultimately is my why, is, the longer I've been in this industry, I've just seen the positive benefits that it has by having, the public informed so you can make proactive financial decisions for your family. Because I've seen what it looks like when people are more reactive. And trust me, you want to be on the proactive side. So I kind of touched on the organization. When it comes to areas of focus, kind of touched on that too. We do full service financial planning for folks. We specialize in working with folks from Advocate as well as Children's Hospital. We do financial planning, investment management, insurance, estate planning, tax planning, kind of everything under the sun. But, not everything applies to everyone. So as I said, a lot of the people on this call, there's some people in their 20s just getting started in their career. There's some people in their 40s, maybe kind of mid-career, trying to make sure that they're on track. And then there's a lot of people who are nearing retirement. A lot of the folks that reach out to me after these webinars are individuals who are right on the cusp of retirement. They want to make sure that they have a plan in place so they can turn off their, salary, but live off their assets. And that's a whole science in and of itself. So enough about who I am not. I am not a lawyer, nor am I a CPA. So everything that we're going to be talking about today, of course, it's high level. It's not meant for individual advice. It's meant for informational purposes. If you do have specific tax questions, consult your tax person. If you do have specific legal questions, it is good to seek out legal counsel. My team and I do have a lot of networks between Wisconsin, Michigan, as well as Illinois, and we can always help direct you to those types of professionals as well that are kind of within our network, and usually we can get you a discount. So if you need those services, let me know. But at the end of the day too, a lot of what we're talking about is financial. So if you're already working with a financial planner, great. Or, you do your annual check-ins with the folks over at Empower, great. Those can be a resource for you as well, just like we are. All right, so this has been an ongoing series that we've been doing for all of you, and it's focused on this concept of financial well-being. The reason that your employers are allowing us to do these is because they value, increasing the collective financial IQ, so to speak, of their employees, so you can participate in the various benefit programs that are available to you, which is a lot. So, there's 4 main pillars of financial well-being, financial wellness, and there is listed as follows. First of all, having control over our day-to-day or month-to-month finances. This is basically synonymous with having a budget. It's a staggering statistic about how many people out there actually do not have any kind of a budget in place. A lot of studies have come out by Fidelity, by Empower, by a lot of these big name financial organizations that you'll hear about. And over half of American citizens don't have a general idea of what's coming into their household every month and what's going out. I say this in almost every meeting that I have with folks, is that your cash flow is the foundation of your financial plan. If you don't have understanding or control over what's coming in, what's going out, and where is it going, you need a serious financial overhaul. And it's okay if you don't. That's part of the reason why people like me have a job. Second pillar here is having the capacity to absorb a financial shock. So similar to the half of Americans not having a budget laid out, actually more so statistically, do not have any form of an emergency fund. So that's what would give you the capacity to absorb a financial shock, is saying, hey, if some type of unforeseen expense occurs, whether the roof starts leaking, furnace breaks down, vehicle needs new tires, some kind of medical event, all of those things can run you upwards of $1,000, $2,000, $3,000, even $4,000. It's good to have some kind of cushion that you can fall back on, so you don't need to rely on credit cards. You don't need to start being subject to interest or any kind of late payment penalties. Establishing a highly liquid, efficient emergency fund is paramount to being financially well. Thirdly, being on track to meet our financial goals. The first step with being on track to meet your financial goals is actually having established financial goals. A lot of folks out there don't, they'll say, hey, I want to retire at 60. And then I'll ask, okay, well, tell me what that looks like. How much money do you need per month? What kind of lifestyle do you want? Do you want to live here? How are you going to spend your time? A lot of people don't start thinking about those things until they're nearer and nearer to their targeted date. The earlier that you can start painting the picture of what you want your financial goals to be, the better of a chance that you have of accomplishing those goals. Because then we can say, hey, this is this far out in the future. Let's dial that back to today. If we know where you want to be then and we know where you are today, first of all, what are you doing? Is that putting you on the track for it? Or looking and saying, hey, we need some alternatives to kind of adjust what you're doing if that's actually your goal. And is that reasonable? One of our presentations that we do throughout the course of the year, and we do have recordings of it, is actually financial goal setting, where I spend the entire, 40 minutes talking specifically about how to set, establish, and hopefully accomplish various financial goals, from retirement to purchasing a home, to helping with college, to debt reduction. And then lastly, having the financial freedom that you can allow you to live the type of life that you want to live. This is kind of encompassing the first three, but it is largely important because that's kind of the check saying, hey, am I financially well or not? Are you able to live life on your terms because you have a plan in place, your budget's in control, and you know you have that rainy day fund? But enough about our overall series. Let's focus on the meat and potatoes about what we're going to talk about today. So we put together this little agenda for you folks saying, okay, first of all, we're going to talk about why is it important that you invest? You know, why can't I just keep my money under my mattress? We're then going to talk about some of the most important concepts of investing. So the first one is going to be risk tolerance. So there's a lot of things baked into that, and I've got quite a few slides to kind of talk you through what risk tolerance is, how you can kind of start to determine your own, and then of course looking at and saying, okay, well, how does my risk tolerance reflect how my investments should theoretically be set up? We're going to do a little bit of a deep dive into stocks. I'm sure all of you have heard of them. A lot of you probably own them, but a lot of people don't conceptually actually know what stocks are, how they work. So we're going to dive into that. Same with bonds. Then we're going to talk about mutual funds, which often can be a combination of the two. Same that I said before. You know, a lot of you, I mean, if you're participating in your company's 401k plan, you own a mutual fund. So it's important to know some of the pros and cons, you know, the benefits as well as drawbacks of stocks, bonds, as well as mutual funds. There's a couple other types of investments that we're going to breeze through, but for the most part, this is going to cover largely what investing is. So going back to what we're saying, first agenda item, why should we be investing, right? The number one reason is that you're taking advantage of compounding growth. You know, Albert Einstein called compounding growth, you know, the one of the wonders of the world. You know, it's not as magnificent maybe as the pyramids or anything like that. However, the way that it works to benefit individuals from an investment standpoint and a retirement standpoint goes without saying. So here's just an example. You know, the market's going to go up, the market's going to go down. You never have control over that directly. You know, it's called volatility. On average, the market trends up. You know, we need to always think about investing as a long-term play, right? So whether you have 20 years, 10 years, or even you're getting started and you have 40 years until you would retire, this is just an example showing, hey, if somebody started investing 40 years ago, you know, I'm 4 years off, so this is going up to 2020. So say you started investing back in 1980 and you just put $1,000 into the stock market and left it alone. On average, if you shared what the S&P 500, and I'll talk about what that is in a little bit, if you just shared in what the average market gain was between 1980 and 2020, that $1,000 40 years later would be 25,000. So realistically, you know, over a 40-year period of time, one lump sum contribution would have 25x'd itself, which is substantial. So the idea behind compounding interest, because you're not touching this money, is saying, hey, I put that $1,000 in and then it earned X. And then the next year, when it earns another percent, not only is your $1,000 earning that interest, but the amount that you earned is also earning that interest. So it's money on top of money on top of money, making money. So that's why Albert Einstein, because he was a big math whiz, he referred to it as one of the wonders of the world. Because when you look at compounding interest, it's the substantial curve up. The longer of a time period, the greater. Because you think about it, say your $1,000 earned 5%, you know, the market gave 5% that year, that's still a good chunk. However, when you're looking at the compounded number, when your 25,000 earned that same 5%, it's significantly higher because that's the money on the money that's earning money. So that's the reason to invest. when we're kind of flashing forward saying, okay, well, what are some other reasons? It's a long-term commitment. So I already said that, the longer of time horizon that you have, that's going to bake into your risk tolerance. But a lot of folks will come to me saying, hey, Lucas, I want to buy a house in 1 to 2 years. Where can I put my money? A lot of times, I'm a little hesitant to say anything because it's like, well, in a bank, it's safe. When you're looking at investing, you need to think of it as a long term. There's no place that you can put money and in a guaranteed sense of the word, say, hey, 1 to 2 years from now, this should be 10 to 15% higher. Anytime you're investing, you're assuming a risk. Okay, so that's why you need to think of it as a longer term perspective and play, because the longer your time period is, the more stress or stretched out and mitigated your risks will become. So risk tolerance, this is kind of our second thing here that we're going to talk about. And arguably, this is going to be the most important topic that we're going to cover today. So risk tolerance, as I alluded to earlier, is basically kind of taking you as an individual and taking a couple different things into account to say, hey, this is this individual's risk profile. This is about how risky their portfolio should be. And when they say risky, they're saying what kind of exposure to stocks versus bonds that you have. So the main things that they're going to look at, first of all, age. A person in their 20s compared to a person in their 50s or 60s, by theory, should have drastically different risk tolerances. And it's what I was just talking about on this previous slide, the term, investing is a long term. Well, if you're 60, you know that you're going to need that money for retirement a lot sooner, right? Now, a 20-year-old, they have a long ways to retirement. They can be riskier. So their risk tolerance would be higher, their tolerance to risk. That kind of waterfalls over into this next one, which is risk capital, right? So it's saying, okay, well, if I lost this money or a big percent of this money, how does that affect your lifestyle? Now, a 20-year-old, when their retirement account goes down, yes, it still hurts, right? However, they have 40, maybe 30, 40, 50 years potentially until they actually need that money to touch it. Whereas when a 50 or 60-year-old's account goes down that same 20%, which normally it's on a bigger nest egg, that's going to be a lot scarier when they were planning to retire in potentially 2 to 5 years and their account just dropped significantly. So the idea is that the older you get, the more conservative your investment strategy should be. Knowledge of investing is always going to be built in. There's nothing saying that a 20-year-old can't be conservative because they hate the idea of ever seeing their account go down. But having an understanding and awareness of what types of investments are out there, why you're set up the way that you are, and having an understanding that you're looking at it and potentially rebalancing and reallocating on an annual basis or even a quarterly basis. And then lastly is comfort level. So like I said, I have worked with some 20-year-olds who are hyper conservative, even though I say, hey, it makes the most sense for you to be aggressive. I can't change a person's investment wiring and how they think. But I've also, too, worked with people who are in their 60s, nearing or in retirement, who are hyper aggressive. So there's no one size fits all. The two 60-year-olds could have drastically different risk tolerances based on their preference. Two 20-year-olds can also have drastically different risk tolerances based on their preference. So that's a personal preference. However, there is kind of what the book would say. And what I mean by that is just in theory, from the financial world, they're saying exactly what I've already echoed, saying the earlier you are in your career, you should be more aggressive, meaning you should hold more equities, or that means kind of stocks or things that are correlated to stocks. So that's kind of what we're looking at in these different pie charts here, is that in the earlier career, over to the left of the screen there, notice that orange portion takes up the biggest part of the pie. So those are our stock holdings, right? Now notice as we go more and more to the right, that orange starts being more overtaken by the blue. So the blue is our bond holdings. So stocks are typically correlated with aggressive or volatile. Now those things shouldn't have a negative connotation. What it's saying is, hey, a stock investment can maybe get you 15% rate of return or more, but it can also lose you 15% rate of return or more. Now, bonds, on the other hand, when we're looking at those, the conservative bet, or our blue on these pie charts, they're basically saying, hey, a bond can usually get you maybe a 5% plus return, and maybe we're only looking at about a 5% decline when the bond market or interest rates aren't doing too well. So big thing to take away with this is typically what the book says, as you get older, you should traditionally get more and more conservative, because going back to this one that we're saying, our risk capital, you need that money sooner, or you know you're going to need that money. And if it goes down significantly in a short period of time, it's going to drastically impact your lifestyle, right? So there's different types of investing. Like I said, there's the ways of investing for people who are earlier in their career, ways to invest for people who are more in their middle of the career, ways to invest for people that are nearing retirement. And then there's ways that you should be investing when you're in retirement. Okay. So macro, this is kind of what I was already talking about. What is our pie chart actually made up of? This is not, there's no rule of thumb, so to speak, as I said, but you're going to want some kind of mix, right? You're going to want a balance of stocks. You're going to want a balance of bonds. And typically you want a balance of cash or cash equivalents. Now I'm going to dive into all three of these a little more in depth, so we can all just keep following along. So when we're looking at these three different asset classes, when we're looking at cash equivalents, that can be anything like your checking or your savings, so money in the bank, any kind of money market account. So often those are found within like a brokerage account that you might hold, but they're going to pay you at like a fixed interest rate. Now, when I say fixed, I mean that it's fixed for the period that they say. They still change those based on what's happening with inflation as well as interest rates. Another cash equivalent that a lot of people are common with is a certificate of deposit, or CD. They have all different terms with certificates of deposits. I've seen them as short as 1 month. I've seen them as long as 2 years. So those are considered cash equivalents. Technically, the money in a cash equivalent account or investment or holding is never going to go down in value, right? So money in your savings account, if the market tanks, you're not going to lose the money in your checking account. This is always your safe money. So your emergency fund, but also too, it's largely a holding of a portfolio. So one of the reasons behind that is when we're going back to this and saying, hey, we've got these cash equivalents. If you're being strategic with your asset allocation and you're doing diligent rebalancing like we do with folks, is when the market goes down and we see our stocks get depressed a little bit by 10, 15, even 20% sometimes, what we're able to do with chunks from the cash is buy in to those stock positions at theoretically a low point or a discount. So that's why rebalancing is very important. Your portfolio shouldn't be static. You don't determine it and then leave it alone for 5 or 10 or 15 years. It should be something that you're visiting at least on an annual basis and making sure that, you have this percent stocks, this percent bonds, this percent cash, and then determining what percentages you need to change. So just want to go on a side note there. Then when we have stocks, so there's 3 main categories of stocks as they're listed here. I'll dive into each of the 3 a little more on the following slides. But big picture, the main 3 are income-oriented stocks, growth-oriented stocks, and then, of course, as you can see, value-oriented stocks. So you're probably saying, Lucas, what does that mean? I'll tell you in a second. Then we're going to kind of go over to bonds, and I'll walk you through the 3 different main types of bonds. So there's corporate bonds, which are issued by like private institutions, municipal bonds, which are issued by, state level governments, and then treasury bonds, which are issued more on a federal level. So all of this, when we look at these different types, when we look at this mix of things, the idea behind that is diversification. And you're always going to hear that when you hear anything related to investing, how to invest, where to invest. That's always going to be one of the key buzzwords that you hear. So what is diversification? In a nutshell, it means that you're not putting all your eggs into one basket. In theory, your retirement plan shouldn't be funneling all your money into Apple stock or Microsoft stock. It should be diversified across a multitude of different stocks, of different bonds, of different types of cash equivalents. When we're looking at all of these different asset categories, it's best that you don't just hold one thing in each. It's best that you have a couple, because if something happens to Apple stock, for example, and that was your entire retirement nest egg, your entire retirement nest egg is going to correlate with the impact of whatever occurred with them. So whether it's a bad news article, a bankruptcy, some kind of labor law, whatever it is, when you're diversified, your eggs are spread across different baskets. And I'm going to go in a little more depth of what those baskets can be in our following slides. So breaking it down between the different types of stocks, as I said, there's a couple different ones here. So I'm going to drive into them a little deeper: our income, our growth, as well as our value. So what are those differences? When we look at income-oriented stocks, right? And you can have all three. I normally recommend that people do have a blend of them. Remember, diversification's key. Compounding interest is key. Those are our big words, and those should be your big takeaways from today too. So with income or dividend paying stocks, that's the name implies what it is. The focus of them and the emphasis on them is that they pay a dividend. So typically these are going to be stable companies, and they're able to pay out these dividends to their shareholders, because when you purchase a stock, you become a part owner of a company. So what these stocks do is say, hey, we don't necessarily need our earnings or our profits in order to continue to expand. We're already kind of at our critical mass point, but we're continuing to be profitable. So we declare a dividend and pay that out to our shareholders. Now, there's a couple different ways that you can get paid out with dividends that are common. The two main ones are, one, they'll pay you a dividend. They'll cut you a check and mail it to you every quarter or every year, depending on the company and how they declare their dividend schedule. And then the other is called a dividend reinvestment program. So what that means is, say the company declared a 5% dividend. So whatever your holdings are, you get to take 5% of the total. And what you do is you can put that 5% of new and purchase more shares through the dividend that they're offering. So like I said, every company kind of has a different dividend schedule. If you're an individual stockholder that pays dividends, normally they make you aware of that. They'll send you an email or even a letter saying, hey, we declared our dividend. It's this. You can expect a check. Or do you want to buy more of our stock with the dividend? So the value of these stocks can still fluctuate, but the idea behind them is that you're not necessarily investing for a return on the stock price. You're investing in these funds because they pay you this hopefully consistent dividend. Now, one caveat to note, and I want to make sure that everybody does know this too, is that dividends are not guaranteed. A company could have been paying dividends for 20 years in a row, and then one year, maybe they had a really bad year, and they can say, hey, sorry, shareholders, we're not going to pay you a dividend. It would look very bad on the stock price and the company, but technically they're not guaranteeing that, hey, you own this stock, we're going to pay you this. So that's kind of going back to what I was saying before, is that when you're investing in stocks, there's always a component of risk. You need to know that. There's no free lunches in the investing world. You're always assuming risk, but it's a trade-off. It's a risk-reward trade-off. You look at that with the difference between stocks and bonds. As I mentioned earlier, stocks have the potential to give you a bigger rate of return, but they also have the potential to lose you more money. Then when we're looking at growth stocks, so unlike dividend stocks, when we're looking at growth stocks, these are typically found, in the technology world, or these rapidly growing companies. We've seen that crazy rise with NVIDIA over the past year or two. That's a perfect example of a growth stock. Like when we look back at, these income stocks, typically in the sectors that we see them, those stable sectors, we see them in like energy companies, financial companies, natural resource companies. With these growth stocks, we're seeing these in sectors where a company can go from $0 of income to 100 million in a couple years. So largely technology. We saw a lot of booms during COVID with companies in the medical space. So the idea with growth stocks is that they usually do not pay you a dividend. They can, in theory, but the main reason that they're a growth stock is because this company is taking all of their profits and shoveling them back into the company. The idea is that, hey, we're going to reinvest all our profits, all our dividends that we would have paid out, so we can keep seeing this company grow and grow and grow, take it to the moon. That's the concept behind them. So individuals will have these in their portfolios for a holding percentage increase. So unlike the dividends that we were talking about before, where you want them to see they're paying out their 4, 5, 6% dividend, these, you want to get that 4, 5, 6, 7+ rate of return on the actual underlying holding. So meaning, hey, I bought Apple when it was still in the garage. Steve Jobs invested and invested and invested in the company, and now my $1,000 Apple stock is worth 50. That's an example of a growth stock. And, it goes without saying, these are considered more risky because, you're trying to swing for the fences. You're betting on a company that's in its infant stages, and you're hoping it becomes the new Apple, the new Tesla, the new Facebook. And then the last type of stock is a value stock. So value stocks, they can technically be in both growth as well as income categories, but the idea behind them is that other people, or the market in and of itself, is pricing them and saying, hey, we think that these stocks are undervalued, meaning that their price to earnings ratio, what it's actually worth versus what it's earning and what the market thinks it's worth, collectively people say, hey, these are undervalued. So the idea behind the value stocks and the value stock play for folks is saying, hey, if I can buy this thing at the cheap, at the low, over time, when everybody else starts to realize that it was undervalued and it goes back to a normal value of what it should be, or what market analysts think it should be, I'll get that percent return, because I bought it at a discount and now it went back to its normal value. So it's worth noting too, with value stocks, those are typically a longer term play, because it can take years and years until an undervalued, potentially undervalued company comes back to its realized value, or what it might be worth. So with stocks, there's the pros and the cons. Benefits, stocks are going to offer you more upside than bonds or cash over a long period of time. The risks and the cons, of course, there's no guarantee with this. You can put your money in any company and there's no guarantee that it's going to go up over the course of the year, even if the market does well. We've seen that in certain years where, the market did great as an overall, but certain stock holdings, hey, they reported low earnings, they had to lay off a bunch of people, and the stock price can go down. So there's no guarantee technically with a stock investment. I mean, it doesn't happen too often, but technically you can lose all value in a stock. You can put $10,000 in some startup company and they could dissolve, they could declare bankruptcy, and technically then your stock's worth absolutely nothing. So there are always risks. Remember, there's always a risk and a return trade-off that you're going to be making in the investment world. But that's not only true of stocks, that's true of bonds as well. All right, so this is a big graph. I know it's kind of difficult to read. It looks like one of those, handmade Amish quilts that you can buy from an antique store or something. But this is showing various sectors in the economy and kind of showing and highlighting why diversification is very important long term. When we're looking at stuff, there's never one play that's always the best. Okay, so up on the top of our graph here, we're showing during the year that we're listing, hey, this is what performed the best during that year. Okay, so 1 year emerging markets is the best in 2007. Well, guess what? The following year, it was the worst one. And then guess what? The next year, it was the best one again. So that's why a lot of individuals, they benefit from having their money in these different buckets. Because when we look at it, you never want to freak out and say, oh my gosh, my emerging market went down 50%. I need to pull all of my money out of it, because then you miss the next year where it went up 78%. So it's important that you have the diversification. And so then, hey, this one's popping off, good, I have some money over there. This one's popping off, good, I have some money over there, so on and so forth. You don't want all your eggs in just developing countries outside the US. You want investments kind of all across the proverbial board that we're looking at here. All right, how are we doing on time? Oh, I'm cruising. All right, bonds. So with bonds, unlike stocks, when you purchase a stock, you're technically a part owner of the company. When you're purchasing a bond is actually a contractual agreement between you and whatever organization or entity issued the bond. Basically, a bond is you loaning money to a certain type of entity, okay? And they use the money that they're, issuing these bonds for in order to, further operations or further certain projects that they're working on. So the main types of bonds that are out there, first of all, we have corporate, and I'll kind of dive into these a little more in depth in our following slides here. So we have corporate, they're issued by corporations. Municipal, they're issued by, states, cities, certain counties, government entities. And then we have treasury, which are issued by the federal government or the Federal Reserve. So corporate bonds, this is, as I mentioned, they're issued by corporations. So these can be private corporations. I've seen them as nonprofits as well. But what they're doing is saying, hey, we're selling this bond. If you purchase this bond for this price at this point in time, we'll give you this percent. So the idea behind them is that you have to hold them for a period of time. Now, corporate bonds do have a secondary market. So say you purchased one, but then at the same time, you're like, I really want that money. I want to buy this or invest in something different. You're not looped into them and tied to them. They have a secondary market, so you can technically sell them off. Typically, the corporate bonds do have the highest rate of return of bonds. However, going back to our risk reward trade-off, they do have risk inherent with them as well, saying, hey, if that company completely defaults or that project really didn't work out, they might not be able to pay the bonds back. So there is risk, but bonds are still considered safer than stocks. If a company does go bankrupt and they have to liquidate, so going down to that last little bullet there, bondholders are paid first. So they're paid instead of stockholders or in front of stockholders. So if a company's liquidating all their assets saying, hey, we're bankrupt, we're done, we can't do this, bondholders do get paid out first on the risk side. It doesn't guarantee that you get your money back or all of your money back, but it's still safer than if you had a stock holding with the same company. Now, companies can issue both stocks as well as bonds. So it's important to note, but that's how the corporate bonds work. Municipal bonds, as I said, they're issued by governments. So small scale though. So counties can have bonds that you can purchase. Cities can have bonds that you can purchase. States can have bonds that you can purchase. So say, a certain county or a certain city wanted to build a new highway, they can issue bonds to people but then, they'll pay their bonds back, but also that's going to give them the working capital to start that project. So bonds are necessary for our economy to function and to flourish. That's what's giving governments money, in a sense, is us. We're borrowing them money for an anticipated rate of return. So like I was saying with, the corporate bonds, hey, they have a secondary market. Municipal bonds do not have a secondary market. So that's what that last little bullet point is saying. It's providing less liquidity prior to their maturity date. So with the municipal bond, say you gave the city of Chicago $10,000 because they're working on building a new botanical garden, and their maturity date, they said, hey, we need to hold this for 2 years, your $10,000. By the end of that 2 years, we promise that we're going to pay you 4% on that $10,000. If after 1 year, you're like, hey, city of Chicago, I really need my $10,000 back, it's more difficult, if not sometimes impossible, for you to get that until the maturity date. Because remember, this is a contractual agreement. You're promising them, here's my funds. They're promising you, hey, we're going to hold them for 2 years and we're going to give you 4%. If you don't honor your part of the promise, what's on keeping them to honor theirs? So typically it's, encouraged that both parties honor their side. There's still risk with these types. I've seen municipalities go bankrupt. The city of Chicago is actually one. They've had to default on a lot of loans and bonds that they have. But typically, an entire city, county, or state is a lot safer than a privately held corporation that we talked about before. The last type of bond, as I mentioned, is treasury bonds. So with treasury bonds, these are issued by the US Treasury and the Federal Reserve. They're backed by the full faith and credit of the US government. Now, I know if our government had a credit score, I don't know how it'd be, because we're a couple trillion in debt, but it's kind of that argument, it's a too big to fail type thing. These are considered the safest bonds, because if our government's defaulting on bonds to their citizens, we might have bigger problems than your bond. That would be kind of a whole full-blown societal collapse. So these are the safest, but typically, going back to our risk reward, we went in order. Hey, corporate bonds are the riskiest, but they give you the best rate of return. Municipal bonds, they're kind of in the middle. They'll give you a good rate of return, but they still have inherent risk. Treasury bonds, they argue that these have virtually no risk, but they're going to pay you the least amount of rate of return. However, with treasury bonds, this is a very good place, when we're talking cash alternatives, to be able to park money, because they're going to help you keep pace with inflation, right? So mutual funds, this is another thing. Everybody on this call, I can almost guarantee, has a mutual fund, because you're participating, or at least I really hope you're participating in your employer plan. They only allow you to pick from mutual funds, right? So mutual funds are a way of automatically diversifying your holdings. So, I'll talk about target date funds, I think, next, or in a couple slides here. But a mutual fund, it's a pool of money that a team of people, or whoever's running the mutual fund, typically, they have a staff of financial professionals who are doing research on the market, picking and choosing individual stocks and bonds for you. This is a much better way of investing from a time-consuming standpoint for you as the investor, because you don't need to necessarily go in there and pick and choose every stock and try to determine every quarter or every year if you need to switch that stock out for a different stock or a different bond or whatever. The idea is that mutual fund companies and the managers of them are going to be making those incremental changes for you on a regular basis. The caveat with that is, hey, if you're getting something, you got to give something, right? So mutual funds do have an internal expense fee. I've seen them, as low, like Vanguard is very much known for low fees. Same with BlackRock, like their iShares. I've seen them as low as 10 basis points, so 0.10%. I've seen them as high, if not higher, as 1%. One thing to be careful, or at least considerate of, when it comes to mutual funds, if you're working like with a financial advisor or potentially thinking to, is that there's something known as loaded mutual funds or A shares, meaning that if you want to purchase a certain type of mutual fund, there's an upfront commission. Okay. And I've seen those go as high as almost 6%. So what that means is that if you had $100 to invest right out of the gate, they're going to pull that $6. So you're going to start in effect in the hole 6%. They used to be more popular, but with the ever growing and ever advancing financial world, those A share mutual funds with upfront commissions have kind of fallen off. I still see a lot of people holding them. I still see a lot of people purchasing them, but there are a lot of alternatives where you don't need to pay those big upfront commissions. Other types, so mutual funds, they also have different types. We'll kind of go quicker too, because I know we're getting close to our noon end time here. So there's money market mutual funds, which is kind of one of the asset classes that we talked about. They're going to be investing in short-term securities, so different types of treasuries, different types of certificates of deposit, different types of banks. The idea is that you would put this, your investment for the money market portion of your portfolio into a money market professionals and let other people go out and shop bank rates, interest rates, bond rates for you. There's, of course, stock mutual funds where they're precisely looking at, hey, this is a growth mutual fund. We're only going to pick a bucket of stocks for you. There's bond mutual funds, which is exactly the same thing, where it's a team of managers and they're going to go out and shop for the best bond rates with the best ratings or XYZ. There's thousands of different kind of mutual funds based on what your goals are, what your risk tolerance is, what you're trying to look to accomplish, and of course, how sensitive you are to fees. You know, because some people would argue, hey, we have a higher fee because we have a better track record. Some people argue, hey, we have a lower fee, it gives us a better track record, right? It depends on what you're looking for. If you need help consulting with mutual funds and assessing the value of one compared to the other, consult your financial person, ask me, whatever it is. And then lastly, that I want to spend a little more time on, because I can guarantee more than half of the people on this call are in them, are these target date funds. So these are built into pretty much every 401k plan. What it is basically is kind of taking into account what we've been talking about with risk tolerance. So going way back to my pie chart, hope nobody's hungry. The idea with these target date funds is they're going to say, okay, Joe, you're 30 years old right now. When do you want to retire? Okay, 30 years from now. Well, they'll pick a target date 30 years in the future. It'll be called target date that year. And every year it's going to slightly move you across this little pie chart here. You know, the closer and closer you get to that date, it's automatically going to start shifting you from equity holdings to bond holdings. Now, that's a benefit because you don't have to actively be thinking about it. You don't need to go in there and tweak it and rebalance it. And that's why they have these set up, and why most people, when they sign up for a 401k plan, they'll automatically put you into these, because it's very hands-off, which is a benefit. Now, it's still invested in mutual funds. They're still going through and picking, in their opinion, what the best stocks, what the best bonds are. Now, the kind of the caveat with it, or the risk, is that they're doing that purely based on your age. Okay, they're not taking into account in any way what's going to be happening in the market. They're only looking at how close are you to your retirement age. We're going to move your stocks and bonds the closer you get, but they're not going to necessarily be paying attention to, hey, Asia is not performing well, we need to pull our money out of Asia, or hey, all the writing is on the wall that we're going to go into a global recession. They're not going to make any changes. They're only making the changes based on your proximity to that number. So, you know, when we look at benefits, they've got the built-in diversification. You have a professional team of managers, and they're good for smaller accounts or accounts that are meant, hey, we need to accumulate. I need to throw my money somewhere to save for retirement. It's good with that. With risks, because it has that automatic rebalancing feature and it's rebalancing mutual fund, typically they're a lot higher in fees compared to if you do it yourself. I mean, you got to pay, if you have somebody else cut your grass, you got to pay them, right? So you're paying for it, but the idea is that, hey, it's less that you need to do, right? So another thing that I was saying too, it's not being tactical with what's happening in the world. So that's another big drawback. Tax is not super applicable because we're talking about 401k plans. The other category that I just want to breeze through, there's ETFs or exchange traded funds. These are meant to track common indexes that are out there. So like I mentioned, or I keep mentioning this S&P 500. The S&P 500 is just the 500 most held stocks or companies. So, there's some ETFs that track that, which is usually indicated as the global, like the financial heartbeat, or the general financial health of the economy is the S&P 500. But there's also ETFs that track specific things that we were talking about, like, hey, there's an ETF for technology or healthcare or defense or aerospace. There's thousands upon thousands of ETFs. What's nice about ETFs compared to mutual funds, because they are very similar to a mutual fund, is that technically there's no professional management with an ETF, meaning an ongoing, a lot of changes and stuff like that. So ETFs are typically a lot lower cost when you're comparing them to like their mutual fund counterparts or potentially like sister funds. So I'm a huge fan of ETFs. A lot of the portfolios that we make have heavy holdings in them just because they are that lower cost, but it's still giving you that diversification that we're looking for. Another thing, these used to be very popular. I think they're falling out of popularity right now, but in the future, they could be popular again. I mean, remember our quilt, right? These real estate investment trusts or REITs, basically it's a mutual fund, but they're pooling their money into like tangible assets. So like real estate. So the idea is that you're giving money to a company that's buying and selling real estate or doing rental properties. That's how you get your rates of return. I won't spend too much time on that. But kind of one of the last big things just to talk about is that we want a balance of these things. Now, I think it's goofy kind of that we have a pyramid. I think it does make more sense that we talked about it, from the pie chart stance of things. But, when you look at it, you want a portion of your portfolio to be exposed to risk, no matter what age you are, because that's always going to be in a long-term stance where you are going to receive the most rate of return. We want some stuff in the middle and we want stuff on the lower end, like our cash and cash equivalents. The balance of this is going to be largely based on two things. It's going to be your preference and your age. That's just kind of how it shakes out. So just in review, I know we're kind of getting close to our hour. Like I said, this whole thing's recorded for all y'all, and I'll send it to the people that weren't able to make it. I already have a bunch of people asking me for it. So, you want to consider what kind of investments are going to work for your individual situation, your risk profile, your time horizon, your comfort, and your preference. Diversification's key, and compound interest is key. Don't panic during market downturns. I saw so many people, unfortunately, when COVID happened, when 2020 happened, and we saw that massive downward spike in our economy, a bunch of people freaked out. They pulled their money out of their 401ks. They shoved it under their mattress. And then, unfortunately, they missed one of the largest market run-ups in the history of our economy. So, part of, I joke about this to clients all the time. Like, I think more of my job is being a therapist and talking people off the ledge, encouraging them to stay invested, to stay in the market. Freaking out and adjusting your entire financial plan because of a market downturn is never a good strategy. You always want to stick to your guns and know, hey, volatility or market fluctuations is a part of my plan. There's no avoiding it if you want a rate of return. And then seek guidance, whether it's a family friend who is licensed, they're a professional, whether it's myself, me and my team are available here as a resource for everybody. We do no cost consultations. I know you guys have some guidance through your employer plans as well. Typically, somebody will ask to meet with you once a year at a minimum. But after these, I usually have one of my juniors reach out to everybody, call, check in on you. I know we're hitting time, so I don't really have time for questions. I gotta hop on a call in 4 minutes anyway. I'd love to chat with you. If you want me to look over your statements, make sure that you're allocated, balanced, on track, whatever it is, it doesn't cost you guys any money as registrants for this webinar, just to give you a little peace of mind. So here's all my contact information. Thank you all so much for continuing to support these ongoing webinars that we're doing. I've been getting nothing but good feedback from folks. So if you have any questions, don't hesitate to reach out. Here's all my contact info. And I hope all of you have a wonderful day. Enjoy Memorial Day weekend, and you take care. We'll see you next month. Bye now.